Hi, George Cavaligos from the floor of the CME Group. I'm a broker with MF Global here in Chicago. Been on the trading floor for about 30 years. Fari Hamzy has been kind enough to allow me to show you our trading floor and a little bit of our color from the bonds and notes here that we trade on the trading floor. 30-year bonds and 10-year notes are our strong point. That's where we've seen a lot of activity over the last couple of years as the Fed has pushed its zero interest rate policy. The short end of the Treasury curve goes out from 0 to about 2 years, and what we call the intermediate sector is 5 years to 7 years, and then the long end is 10s and 30s. We're going to talk about 10s and 30s today because we're coming into the Fed meeting. Today is Tuesday. The meeting started today. The Fed announcement will be tomorrow afternoon, about 1:15 Chicago time. Most of us think the Fed is going to try and come out with a new program to try and backstop the economy here and keep rates low. We're going to look at a specific sector of the curve. And first off, a little history lesson. If we look back at the financial crisis in 2008, we look at the end of the year, we see that most of the Treasury curve from 0 to 10 made very low yields back then. Since 2008, yields perked up a little bit. And now since early 2011, we've seen those rates go back down again as the economy has showed more weakness and the turmoil in Europe has causes flight to quality, flight to safety, where people come and buy bonds and notes and treasuries of any maturity to park their cash in a safe place. There's a little bit of an anomaly here where the 30-year bond has not made new lows this time down. If you look at the 30-year chart, see that the low in 2008 was 2.52%. 30-year bonds, which are around their recent low yields, are only trading at 3.22% right now. So we're about 70 basis points or 0.7% above those old Treasury yield lows in the 30-year. Now I think the Fed sees this, and that's what they're looking at as a sort of, not a layup, but an easier place to try and maintain some type of stimulus in the economy by bringing down 30-year yields. There's talk, and most people in the financial markets are looking for the Fed to come with what they call an Operation Twist type program, where they will either buy 30-year notes and or sell short-term notes to keep their maturities a little bit, or to move their maturities a little bit longer term duration. I think they'll probably come with some type of program where they're going to push 30-year yields down. And it's an easy trade for them. It'll tend to backstop the economy. I don't think it's a be-all, end-all response to the financial crisis that we're still going through. We need a little help from Congress and the administration, specifically in the housing market, which is what most people on the consumer side are struggling with at this point. We're taking a look at a couple trades. The curve, the Treasury yield curve, there's a couple opportunities here that we've looked at, whether we're going to be selling 2 years and buying 10 years as a nice opportunity. It's currently trading around 180 if you look at the yield difference between those two sectors of the curve. Long term, that trade, it's already flattened quite a bit. The highs were made back in February at 290 basis points. But historically, we think that can go down more. We think over time here, that should work its way down towards 70 to 90 basis points if you follow historical trends. Also, the knob spread, what we like to trade is between the 10-year note and the 30-year note. That is not at any kind of extreme levels here, but we think that might be a spot where there's an opportunity that hasn't been seeing a lot of flattening yet. We've already seen some tremendous flattening, 2s, 10s, 2-year, 5-year. We have not seen a tremendous amount of flattening in the 10s, 30s spread. We think maybe if you take a look at the knob spread, which is the notes over the bonds, selling 10 notes, buying 6 bonds on a ratio basis will keep, in the futures market, will keep the yield differentials the same. That might be a great trade to take a look at. Thank you very much for your time. Try to keep up with the markets through Fari's great website here, guys. Have a great day.